Good morning. Today's my class is on rules of debit and credit. There are three main rules of debit and credit. First one, debit what comes in, credit what goes out. It is the first rule. Second rule is debit the receiver, credit the giver. Third rule is debit all expenses and losses, credit all incomes and gains. For example, when we go to the first rule is debit what comes in, credit what goes out. On 1st April 2021, purchased machinery rupees 50,000. Here we have to debit the item which is coming into the business firm. Here we are purchasing machinery, so machinery account should be debited, and for purchasing machinery we have to pay something. Here we are paying cash, so cash is going out. So in this case, we have to debit machinery, credit cash. The rule is like this: debit what comes in, credit what goes out. Here machinery is coming into the firm, so we have to debit machinery, and cash is going out of the firm. So here we have to credit cash. So the journal entry for purchase machinery is machinery account debited to cash account. Next example, on 7th April 2021, we purchased furniture rupees 15,000. Here also we are applying this rule: debit what comes in, credit what goes out. Here we are purchasing furniture. While purchasing furniture, furniture is an asset. As previously mentioned, machinery too is an asset. So we debit what comes in. Here furniture is coming into the firm, so we have to debit furniture, and here cash is going out of the firm, so we have to credit cash. So according to this rule of debit what comes in, credit what goes out, our journal entry will be furniture account debited to cash account rupees 15,000. So the first rule is over. Second rule, debit the receiver, credit the giver. One example, on 7th January 2021, paid to Suresh by check rupees 75,000. Here we have made a payment to a party named Suresh. The payment is made by check rupees 75,000. So according to this rule, debit the receiver, credit the giver. Here we have to debit the receiver. Here receiver is Suresh, so we have to debit Suresh. And what is going out, what is reducing? Here we are making the payment by check. So here our bank balance is reducing. So we have to credit bank account. So the journal entry will be Suresh account debited to bank account rupees 75,000. So this is according to the rule: debit the receiver, credit the giver. Here Suresh is the receiver, and the bank balance is reducing, so we are crediting bank account. Another example, on 9th January 2021, received from Ramesh rupees 90,000. Here we received cash from Ramesh rupees 90,000. So according to the rule, debit the receiver, credit the giver. Here the giver is Ramesh. So according to the rule of debit and credit, debit the receiver, credit the giver is the rule we are talking now. So here the giver is Mr. Ramesh, so we have to credit Ramesh. So journal entry will be cash account debited to Ramesh account 90,000, because what is coming to us is, or what we are receiving is cash. So cash account should be debited, and we have to credit the giver. Here giver is Mr. Ramesh, so we are crediting Ramesh. Therefore the journal entry will be cash account debited 90,000 to Ramesh account 90,000. Next, third rule. Third rule of debit and credit. Debit all expenses and losses, credit all incomes and gain. Our first example is on 8th April 2021, paid salary rupees 10,000. Paying salary to employees is an expense. Salary is an indirect expense. So we are making a payment here. So according to the rule of debit and credit, debit all expenses and losses. Here salary is an expense. So we have to debit the salary. Debit the salary, or according to rule we have to debit all expenses. So here the journal entry will be salary account debited 10,000, and what is going out from us is cash. So cash should be credited. So journal entry will be salary account debited to cash account rupees 10,000. So we are following the rule: debit all expenses and losses, credit all income and gain. And another example is 10th April. 10th April 2021, received interest by check. Received interest by check. Here interest is an indirect income. So we are receiving interest by check. So according to the rule, we have to debit all expenses and losses, credit all income and gain. Here interest, we are receiving interest by check. So interest received by check is indirect income. In this case, we have to credit interest because interest is an income. And here we are getting the interest by check. Therefore, we have to debit bank account. So the journal entry will be bank account debited 25,000 to interest account 25,000. So these are the few examples and what is in the rules of debit and credit. Once more I will repeat the three important rules of debit and credit. First one, debit what comes in, credit what goes out. Second rule, debit the receiver, credit the giver. Third rule, debit all expenses and losses, credit all income and gain. Okay, then we can move to some important terms in accounting or accountancy. One is assets. Assets are valuable things owned by business. It includes land and building, plant and machinery, furniture, fixtures, etc. Second term is liability. Liability is amount payable to outsiders. It means the amount which the firm has to pay in future to outside parties. For example, bank loan, bank overdraft, etc. Third one, expenses. Expenses are those items which the business firm has to pay in the due course of business for its operations. In operations, expenses include salaries, rent, miscellaneous expenses, water bill, electricity bill, taxes, depreciation, etc. Income. Next term is income. Income means the gain or revenue earned by business from its operations. It includes rent received, interest received, commission received, dividend received, etc. And these are some of the important important terms in business. The important terms in business are some of the important terms in business are assets, liabilities, revenue, expenses. And I will conclude by saying one more thing. While preparing accounts, we are preparing some important books or accounts. First, we have to start from journal, then we move to ledger, then we move to trial balance. In journal, we record business transactions. We journalize the business transactions. Then we go to ledger. In ledger account, we create various accounts or various books. Example, cash account, bank account, capital account, purchases account, sales account, etc. After ledger creation or after preparing ledger account, we prepare trial balance. In trial balance, we record or maintain the balances of assets, expenses, liability, income, and capital. After preparing trial balance, we prepare final accounts, that is trading, profit and loss account, and balance sheet. Trading account is prepared to ascertain gross profit. Then we prepare profit and loss account. Profit and loss account is prepared to ascertain net profit. Finally, we prepare balance sheet. Balance sheet we prepare to find out the financial position of the business. Balance sheet reveals or shows information regarding the assets, liabilities, and capital of the business. Thank you.